The reason that a lot of genuinely smart people end up with way too much of their net worth tied into one company stock. And it usually isn't that they don't know it's risky because they do. It's that every time they think about selling, one thing stops them: the tax bill. So I want to walk you through a version of that today because the tax bill people are picturing is very often not the one they'd actually get. So let's call this scenario. We're going to talk about Tom. He's 51, senior engineer at a public tech company with years of RSU already vested. And that stock has quietly grown into the single biggest thing on his balance sheet. So he knows it's concentrated, but he's held on to it for years because he's convinced that selling it would trigger a massive capital gain. So he leaves it alone, and every year the position gets bigger and scarier to touch. Here's what he was missing. When your RSUs vest, you've already paid the tax on them, which is ordinary income, on that full amount the day they vested. That part's done. So the only tax that's left when you sell is the capital gain, and it's only going to be on the growth. So here's the key: your cost basis is the price on the date the shares were vested, which means shares that vested recently that didn't have time to grow, they almost have no gain. And if there's no gain, that means there's no tax. So Tom didn't have one big concentrated position. He had two completely different kinds of shares of about 1.6 million in company stock. That's around 600,000 of vested shares just the last couple of years. And they were trading right about where they vested. So selling of all of them would have cost him a tax bill in the low five figures. The other million or so was older. So these vested a while back. That would be $550, for example. We're the scenario, right? So let's say it's that. So that's going to be long-term capital gain. And for those shares, he was right. His instincts were right that if he sold them, he would have a tax bill. So the smart move is to not sell them until you're in a lower income tax bracket. So let's say retirement. And at that time, it can get taxed at 15%, 0%, much lower. This is what good planning is about. So he was just applying the wrong shares and letting it freeze. So once we sorted his stock by cost basis instead of treating it as one block, the plan was straightforward. Sell the freshly vested shares, low gain shares first, taking real risk off the table, almost no tax costs. Put future vests on an automatic selling plan so they get diversified the moment they land and before they turn into appreciated shares. And for the older shares, hold on to them until he's in a lower income tax bracket, like when he retires. We also earmark those for charitable giving. So he gives the appreciated stock instead of cash and pays the gain on it. So the big shift for Tom wasn't taking on more risk to dodge taxes. It was realizing that concentrating your holding by accident is just risk. You've been sitting on company stock because you assume selling means a big tax bill. I'd really encourage you to find out which of your shares that's actually true for. The answer is going to surprise you. I'm Randa Hoffman with Radiant Wealth Planning. Thanks for watching.